Hello, everyone. Welcome to the market update for Tuesday, November the 1st. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com, Jerry at TradersPro.com. Let's get started. The market is back in kind of an area here where it's still kind of in this area where it could go either way. It's a little bit frustrating. You like to have a little bit of confidence in where you think the market is going. And we've had a lot of these days over the last few months or a lot of these weeks sometimes where it's the market has been in a spot or it's been acting in a way where it could go either way. And I think, sometimes we're always looking for a direction in the market. Is the market going to go up or is the market going to go down? I think sometimes we forget that occasionally the market just moves sideways, and sometimes it can move in a real long sideways range. We saw this happen with the Russell 2000 last year. For almost the entire year, it moved in a sideways range and didn't break out of that range for pretty much the whole year. So it could be that, I'm not saying that I don't see visually that we're in a sideways trend at all yet, but I think it's important to point that out, that when you start to see the market indecisive and looks like it's starting to go up and then it looks like it's starting to go down, when you feel like you're just whipsawing a little bit, it's not a bad idea to step back and look at the charts and see if we're just moving sideways. And if we are, a lot of times we're moving sideways in a range. Like I said, we're not there yet, but sometimes we can see a range that we're in. Excuse me, and we can just trade the range. If you start to notice that you've been in this downtrend and then suddenly it looks like you're starting to move up, and then you come back down and move up and come back down, you can start to notice that maybe you got an upper and lower level, and you can start to just kind of trade these levels. And you can, again, I don't see the evidence of that right now. I'm just saying that a lot of times when I get, and I'm just going over my experience over 20 years of doing this, that a lot of times when it feels like, you feel bullish one week and bearish the next week and bullish the next week, a lot of times it's the market setting up this sideways type trend. Hopefully that doesn't happen, because those are some of the most frustrating markets to trade, because it just feels like it's not going anywhere. Again, we're not there yet, but I just want to throw that out there as something to kind of keep in mind. As far as the direction alerts, still in a bear market, and so again, the longer term trend is still considered down, and until that changes, we're going to have a little bit more of a defensive type approach. I get asked this a lot. I have been getting asked this a lot recently, that when it gets to stocks in the portfolio or the stock specific class in general, when we're going over particular trades, that maybe we're not following the signal system as closely, or some of the software signals, maybe I'm not following this closely, and I've been called out on that. Again, I get back to the fact that we're in a bear market. We're not. This is a trend following software that's really designed to find bull markets or uptrending markets, and it has. We've pointed out oil. Like I said, we're in a lot of energy stocks in the portfolio. It has been outperforming in this environment. But again, we could sit back and do nothing, which is typically what you're supposed to do for the most part in a bear market, at least if you don't have a lot of trading experience, is to go to cash and kind of wait until the market starts trending up again. But there are some creative things you can do while you're waiting for that to happen. That's a lot of what I've been doing in the portfolio lately. But we're still in a bear market. As far as the other directional alerts, momentum is picked up quite a bit. We're almost in an extreme range here on momentum. The problem, though, and this is why I've been very suspicious of the rally. Well, I've been suspicious of the rally for the most part over the last couple weeks because of the fact that it looks like a bearish ABC pattern. It looks corrective. It looks more choppy, more sideways, at least on all the other indexes except for the Dow. But this is another kind of clue to be a little bit cautious. Again, you're not going to base your entire decision on this, but you've got momentum that's really picked up, but the breadth has lagged. You see the breadth indicators lagged quite a bit. So what does that mean? Well, that means that we've had a big sharp rally here, but the participation isn't there. It's only been a few stocks, and really, if you've been paying attention to what's been going on over the last couple weeks, it's been the large cap stocks, the big Dow stocks. The Dow average has really taken off, but you can look at the NASDAQ 100. NASDAQ 100 has really lagged the move. We pointed that out. We'll point it out again here when we look at the charts. So it's not a broad-based participation, and you always worry about that because in healthy uptrends, there's usually a lot of participation in the rallies. When it's only when it narrows down to just a few sectors or a few stocks, there was a period there a while back. This is going back quite a ways, but there was a period a while back where everything was going into the FANG stocks. You remember the FANG acronym? That was Facebook, Amazon, Netflix, Google, Microsoft. All the money was going into those stocks, and there were a lot of other stocks that were lagging that, and what it created was an illusion that the whole market was going up when, like I said, it was during this period where the Russell 2000 went sideways for a year, while these FANG stocks went straight up. I mean, they took off. So there's very few stocks that were creating that move, and you always have to be a little bit suspicious about that. Now, again, it doesn't mean you're going to trade that alone. But it's something to just kind of tuck away in the back of your mind that if for some reason we roll over and start dropping again, that could be a reason that could have been an early warning sign of that. Now this could change too. Suddenly you can see the breadth pick up speed and catch up to momentum. And that's something to look for as well. And that could confirm the rally if that were to happen, to see more stocks participating in it. More specifically, what you could look for is, do you start to see the NASDAQ stocks start to take off again? Apple and Amazon and Microsoft and some of those stocks start participating in the rally. And it's been the opposite. They've really kind of gone the opposite direction. But that's something to look for. Sentiment indicator is in that extreme range. We've been between high and extreme for a while now. We're creeping a little bit closer to the right side of that. That could be an indication that we could get closer to a pullback if that were to happen. But again, it would need to push a little bit further to that side to reach we're already in the extreme range, but a lot of times when we get to start moving, and we are moving in the right side of the halfway part of this box, this is the area where you start to consider the more extreme condition. We'll look at the VIX indicator, and I can show you a couple things there that we can kind of watch and keep an eye on as far as what that could be signaling as well. Buy-sell ratios obviously the buys have been outpacing the sells, but we're not at an extreme level here. We're not extremely wide. There's not a big wide gap there between the two. If it gets up into about this area right here, which it could do very quickly. I mean, you could have a really big rally day and it could push into this extreme range pretty quick, especially since there's a lot of stocks that are in that hold range right now. And anytime the market moves higher, they're going from hold to buy. We've seen a little bit of a surge in that lately. You can also see it in another area here. I'll show you as well. But this other sentiment indicator is creeping up here close to an overbought area, which would be bearish. Not quite there yet, but like I showed you on the direction alert sentiment indicator, we're in that middle part of that extreme range. We could go a little bit further. This could go a little bit further up and hit that red line. But you notice that every time it kind of hits that red line or gets real close to it, you get kind of a market pullback that tends to happen out of that. So that's something to keep an eye on as well. Again, what we're doing for those that are new is we're just analyzing the conditions that we're in. We want to know what kind of market conditions we're in, so then we can start to make our trade decisions. We want to be going with that market momentum as much as possible. And like I said, we're not going to base our decision on any one of these clues that we're looking at, but each of these clues can tell us something different about the condition of the market. And what we're starting to see a little bit is that the market is starting to get a little bit overbought. It's not extremely overbought, but there are pockets. There are pockets that are really overbought. You go look at the Dow. You go look at the Dow stocks. And what you'll find is, and this is why I think we're probably a little bit more likely to get a pullback here soon, is because you either see stocks that have gone parabolic. You know, go look at it like a McDonald's or what are some of the ones that I was looking at that? But there's a bunch of them, and I could even pull those in, and we can take a look at them here today. But they've either gone parabolic and they're extremely overbought, or they have rallied, but they've lagged a little bit. And they have kind of like a bearish. It looks like they're on a C leg of a bearish ABC pattern. In both cases, this could mean that if we get a market pullback, that these stocks might have a bigger move down, and these stocks might just be, pulling back within that uptrend. They might be just providing another entry point within their uptrend. So either way, you're starting to see the market get in a position where it's starting to increase the probability of getting some sort of a pullback here pretty soon. So that's just something to keep in mind. This is not an area where you usually like to get into new positions, get into new long positions when the market is starting to get stretched. You want to wait for it to kind of pull back and then look to get in, off of those pullbacks, and see if some of those stocks that are stretched a little bit come back a little bit. It's just a matter of being a little bit patient and not feeling like you're missing out. That's another thing too that can happen in this area. People have been resistant to buy lately, and now that they see the market up, it was talked about yesterday that the Dow had its biggest month since 1976 or something like that. And so when people hear that, the average person hears that, they feel like, oh, it's over, the bottom is in, I don't want to miss out, and they start just jumping in. And this is right in an area here where we could start to see a little bit of a pullback here. So it could be a little bit of a dangerous entry point. The index tab up here, one thing that you can start to look at here is you can start to look at the buy-sell ratio, buy-sell ratios here. What is going on here? I can't tell if it's the site or it could be my computer. I need to get a new computer. It's been acting a little bit weird, but I don't know if you're like me. I like it's like I still have an older version of the iPhone. It's like when I get comfortable with something and I know how to use it, I know everything. I don't like new things and trying to figure out new stuff, and so I've been a little resistant to get a new computer here, but I probably need to. It's probably about time I did that. But well, let me see if I can pull this in here. There we go. So you can see what you want to keep an eye on is, and we're starting to see it here. We're starting to see a little bit of the extremes. When you start to get to double digits on the ratios, the buy-sell ratios, that's when things are starting to get a little bit overbought. And we're really overbought on the Dow Industrials. Out of the 30 Dow stocks, 26 of them have buys, 3 of them have holds, and only 1 of them has a sell. Okay. Now that reflects what we've seen the Dow do over the last month. Okay, but we're getting into an area here where we're getting a little bit overbought. Now, just because something's overbought doesn't mean it has to pull back or come down immediately or anything like that. Stocks can stay overbought. Markets can stay overbought for a long period of time. They can stay oversold for a long period of time. We never want to make a decision just on that alone, but if you start to see bearish reversal candles showing up and you already know you're in an overbought condition, then you can, usually there's a pretty high probability you'll get some sort of a pullback. Look at the Dow composite one right here. You've got 44 stocks have a buy and only 1 has a sell. S&P 500, this is getting a little bit more broad. You're still double digits though. 288 of the S&P 500 stocks have buy signals, only 22 have sells. Now you can see the breadth now. Okay, so we've been focusing on some of the larger companies, the Dow companies, the larger the S&P companies. If you go to the broader Russell 3000, it's not yet at double digits, and that's showing you that lack of breadth. There's a lot of stocks that are lagging a little bit here, and maybe aren't participating as much in that recent rally. But now, again, there's a couple ways to look at it. You can look at it as these indexes will need to pull back to get more in line with these indexes down here, or that suddenly we'll see money flow into the small caps and they'll start taking off to catch up. That we'll start to see this maybe this will end up at double digits here, and we'll start to see an outperformance in the Russell. Now, these are going to be things we want to look for then on the charts. Are we seeing that probability on the charts? When we get to the charts, that's what's going to come up next here. But I just want to point that out, that this can show you some clues as to whether things are getting overbought, oversold. When you start to see double digits in the ratios, it doesn't mean that it can't keep becoming more overbought. The Dow Industrials had double digit ratio a week or two ago, and it went from like 12 to 1 to 26 to 1. Okay. But it's just a recognition of you can start to see when things get a little bit overbought when you start to see these double digit ratios here. All right, let's take a look at our charts. We'll start with the SPY. Now, last week, the last update I had on Thursday, we were focusing on the fact this looked like a bearish ABC pattern. Again, I talked about how wave C looked about the same length as wave A. We have the 5 waves down and looked like the 3 waves back up. We had a bearish reversal candle on Wednesday, and then Thursday it looks like we were confirming it. We are going to close below the low of that Wednesday low. I'm telling you, with that pattern like that, there's a very high probability to get a move down. Now, when we talk, remember, that's all we can do in trading is analyze probabilities. But we try to stay with the probabilities on the right side of or with the larger probability as much as we possibly can. But we always have to remember that markets will occasionally make the lower probability move, and that's why we can't always be right, and we're not always going to be right. But it did throw a little bit of a wrinkle on Friday where it rallied all the way back up. And what I was looking at was, I think I even mentioned this on Tuesday, was if we rallied up above that high right there, that we'd have to start to turn a little bit more bullish at that point. Because if it shakes us, if it doesn't drop off of that pattern, and especially if it breaks out and goes higher, then you've got to, you can't just, you've got to look at what's actually going on. You can't just be stuck with what you think is going to happen and start saying, well, it's got to go down, it's got to go down. No, it doesn't have to go down. It could morph into an uptrend right there. And now with it going higher right there, you've got to wonder, is this a 5 waves up? Is this wave 1, 2, 3, 4, 5? And who knows, are we still in 5? Although this is a bearish reversal candle today. Again, bearish reversal candles are very short term. They're just saying what should happen tomorrow. Based off of that, if we close like this, we should go lower tomorrow at some point. Whether we open lower doesn't mean it's gonna drop. It has to drop dramatically off of that. But with what we've been talking about, that the market, it looks like things are getting stretched a little bit, and then you see a bearish reversal candle. You start to wonder, could this be the start of a bigger move down? Now, the S&P and the Nasdaq still look like, and the Russell for the most part still look like that these could be corrective patterns. Meaning there still could be a correction of this whole move down that leads to another move down. The Dow, though, it's really hard for me to make that argument. The Dow just looks like it's in an uptrend now. It really would be a stretch to consider that whole rally a corrective move. Let's take a look at that. So here's the Dow chart. This is too impulsive for me to call that a corrective move. If you're calling this wave A, wave B, wave C, remember, wave C will tend to be about the same length as wave A. It can be a little bit longer, a little bit shorter, but this would be like almost 3 times as long if you're calling that wave C. So I don't know if that is the case here. If that is it just looks too impulsive to be a corrective move. But that's where, again, this is where you start to get the mixed signals, because the other indexes look like they could be corrective moves, that we could go lower. They don't look very impulsive, but especially the NASDAQ 100. So, and it's hard to assume that, can you have the Dow and the NASDAQ go in opposite directions? Actually, you can to some extent. I mean, the problem is that they can move in opposite directions for a little while, but you're not going to get 4-month trends in opposite directions because there's too much of a crossover there. You've got some NASDAQ 100 stocks that are in the Dow 30, and you're not usually going to see that big of a divergence. By the way, if you're wondering how can that happen, how can you have markets move in the same direction on a daily basis? Because we see it, right? You can see that the Dow is down today and the NASDAQ is down today. But how could they be moving in the same direction daily, but be trending in opposite directions? Well, let me show you how that can happen. Let's say you have a stock that's in an uptrend. And then you have a stock that's right. Let's start. start right here. So you could have this big move up right here in one index or one stock, and you could see this could lag. It could go up right here, but it's lag. It's just a step within the downtrend. Then you get this little pullback within the uptrend, and the same time it's doing that, you get a bigger move down in the other stock or the other index. You get another up day right here, up days in a row there, and here it's sluggish. It does rally, but it doesn't rally very much. It's just that step. You get a little pullback right here, and this has a bigger move down. So that's how you could be moving the same direction daily or even consecutive days, but actually be trending in the opposite direction. And that's why it's important to look at the charts and see what the charts are showing. That's why it's important to, there've been a lot of weeks where we've only analyzed the S&P, and that's because the other charts, the Dow look the same, the NASDAQ look the same. So I don't spend time going on with the other indexes. Right now, we're spending a lot more time analyzing each individual index because they're not moving in the same direction. The Dow is outperforming and the NASDAQ is underperforming. So, and again, this is what led to what I started off class talking about, which is, maybe we're going to be chopping sideways for a little while. Maybe what we see is that then we may see the Dow stocks start pulling back and correcting a little bit, maybe some of that money going into the NASDAQ 100 stocks, and they start rallying a little bit stronger or something like that. But overall, we start maybe moving in a big, long sideways range or something like that. Well, I don't know. We'll see. That's always something. Whenever I start seeing mixed markets like that, I start thinking that actually mixed markets, when you have a real distinct difference between them, usually that's considered bearish. If we have had a lot of those days where the Dow was up and the NASDAQ was down, you tend to view that as being more of a bearish. And this gets back to the market breadth argument, that it's usually a sign that very few stocks are participating in that rally, and so it's harder to trust that rally. All right, so the Dow, though, again, we've got a bearish reversal candle on the Dow today. If that holds, again, we got time left before the market closes, but you've got the Dow that's in the extreme reversal risk. Now, again, it could go to the far right side. It could become even more extreme, but it is in the extreme reversal risk. It's gone up a little bit too far, too fast. And you're getting a little bit of a bearish reversal candle today. If it closes down near the lows of the day, that'd be what we call a bearish engulfing pattern. It completely engulfed the day before, the candle of the day before. Technically, where it's at right now could still be considered an engulfing pattern, because you look to see, does it engulf the body of the previous day, the body of the candle of the previous day, not the wick, so to speak. Or the intraday high and intraday low. But, if it does close closer to the lows of the day, it would engulf everything and that's usually a stronger reversal signal when that takes place. And you could kind of walk through what's happened over the last couple of days. So Friday, we had a big up day. Yesterday was kind of an indecision day. So you see that candle right there. That's a what we call a spinning top candle. Now, in the context of this was telling me yesterday. It was telling me there's a little bit of buying exhaustion. That the buyers were still there, but they weren't able to push prices higher. We saw a little bit lighter volumes yesterday. Now, again, that doesn't mean that buyers can't find another reason to buy. And to be honest with you, you also have to keep in mind that this week there are things coming up that could cause people to pause. What do we have tomorrow? Tomorrow is the Fed meeting. We know what the Fed's going to do. They're going to raise 75 basis points. If they don't, if it's higher than that or lower than that, it's going to freak the market out because the market's expecting that. But the big thing is going to be, what do they do after that? Are they going to hint towards slowing the rate hikes down? Or are they what is the language? That's going to be the key thing that's going to move the market. But the Fed meeting is this week. That's going to be a reason to move the market one way or the other. And maybe that's why we're seeing these mixed signals right now where it could go either way. You've got the jobs report on Friday. And be honest with you, the Fed could come out and have certain language, not knowing what the jobs report's going to be this Friday, and then that could change when the jobs report comes out. That could cause them to be lean, make it more likely that the rate hikes continue or not. Remember, the Fed's looking for the Fed is looking for some sort of a slowdown, or they want unemployment to go up because that's going to help the spending problem that is creating a lot of the inflation right now. There's too much spending going on out there. They want to slow that down. They want to keep you from buying that new TV and that new, whatever you want to buy, because that's fueling the inflation problem. The way that they want to deal with that is to get you to where you can't afford to buy that new TV because you just lost your job, or you're worried about your job, and that slows that down. Anyway, it's important to know what the Fed is trying to do, though, because if you think the Fed, for so many years, the Fed has been behind the market, fueling the market, and now it's just the opposite. They're trying to kind of crush the market a little bit, and you just better be aware that that's kind of what they're trying to do right now. So the jobs report comes out Friday. And then next week you have the elections. So there's a lot of reasons coming up for buying or selling. And again, we're a day before the start, all kind of starts, which means that could be this could be just a temporary pause, and it could be because that Fed report comes out in the afternoon, 2 hours before the market closes, that if this does hold, that we may have an open lower. But then it could come right back up after that report comes out. So it could just be real temporary. All right, let's take a look at the NASDAQ. And you can see clearly the sluggish, it's not participating. This does not look impulsive. Okay? Obviously, you have the underperformance here of the NASDAQ. Now, again, why is this significant? Well, the NASDAQ tends to be a leading indicator. Okay, it tends to be leading the way. Now, you could make the argument that, well, because of the conditions we're in right now, that the big institutional traders aren't touching the tech stocks or the high PE stocks, the stocks that aren't earning a lot of money. They're going towards the value stocks, the industrial stocks. They're kind of holding on to the safety of those companies and betting on the safety of those companies. And that is what's happening. That's what's going on. But that's not typically how bull markets. Usually in bull markets, at least over the last 20 years. It's been the tech stocks that have been leading the way, particularly the chip stocks. And so that's why we keep kind of looking at those and seeing if they're participating. And we haven't seen that. And so, again, it makes you a little suspicious of trusting the rally. That's why we add it. That's why it's part of the analysis is what is it showing us? And if you can notice here, I think the big thing that I noticed here is that we had that big rally on Friday, but the NASDAQ 100 didn't even get above the previous high, the high from earlier in the week. What was that? That was last Tuesday. Was that last Tuesday right here? But it didn't even get above that. And so it really lagged. Although it was a big up day for the NASDAQ, it lagged that. It did not get above that high. By the way, let me go back to the Dow real quick. Because remember last week I was showing you the retracement levels, and the Dow was sitting right at right at the 618. I think there's right here is that 618 retracement level. And remember what I said? I said if it gets above that, there's a probability shift there. You've got to start to, there's a less of a chance at that point that this is a correction for another move down, and becomes more of a probability that you're in an uptrend at that point. And we had that big Friday move that just blew through that 618 retracement level. Okay. And so that's why I definitely turned more bullish on the Dow. Now the other indexes are still in that retracement zone range. Again, are they going to be following? I don't know. That's what we'll be looking for the next week or two, is to suddenly the NASDAQ take off and start trying to catch up to the industrials, or, do we see another move down, which could be happening as well. Again, we're getting back to kind of the coin flip conditions we could be in. Although, again, with that Dow chart showing that bearish reversal candle and we're showing a lot of bearish reversal candles today, I think there's a pretty high probability in the near term we get some sort of pullback. But then watch the pullback too, especially the Dow. Does it pull back in more of a choppy, corrective type way? See right in here, when it pulled back, look how it was more sideways right here, more choppy. It did have a decent bearish candle right there, but then it just moved sideways for a few days. That made it more likely that it was going to go up. This was acting more corrective. So do you start to see the same? And it could drop still as well, but do you start to see it more sluggish on the down days where it's not dropping in a very big way? You start to see that. I think we saw that. I think I showed you that right here where we were dropping. We had a bearish candle right here. We started to drop, but then we were fighting it. And I looked at that and I'm like, boy, this thing looks like actually is looking like it's about ready to go up instead of down. It's not dropping. It should be dropping off of that bearish reversal candle, and it's not. You look for the same thing. Is it, so what happens if tomorrow or sometime this week you get a big drop, or we get a big move down where it looks more impulsive? Well, then yeah, maybe this is leading to a bigger move down. And that's what I'm going to be looking for. Is it right now? It's looking like we could pull back. Okay, how does that pullback look? Does it look like something I could buy? If it's sluggish, it's something I could maybe buy into. And maybe this sets up perfectly for Thursday's class, where we'll have the Fed news. We'll be before the jobs report. We'll have the Fed news to where maybe we could see if we're getting just a choppy pullback that we could buy into, or maybe it's something a little bit more impulsive. Russell 2000, again, this one's kind of, this still could be wave A, wave B, wave C. I mean, if that is wave C, it's getting a little bit long. It's right on that borderline. It's not, the Dow is all the way up here in comparison. And we got a, bearish reversal candle today. Now you say, well, the Dow's up today. Well, this is, again, this is a pretty strong bearish reversal when it's still showing the index is up, but actually we're lower from where we opened. So if we were to close the way it looks right now, we're lower for the day, but still higher than where we closed the day before. That's a bearish reversal. And again, it could be very short term. We had one right here. We just dropped, like I said, a couple of days right there, and then it took off again. That you could always find cases where you get that and it didn't reverse. I mean, again, it's none of these things I show you are absolute or always going to work. But again, from a probability standpoint, well, context is important. You got to have a run up ahead of that to really make that price action stronger. We've had a good run up right here. If that holds, that's a pretty high probability that we see some sort of a downward move the next day off of that. All right, how the other markets look. The bond market, we had that sharp rally right here. And we want to pay attention to this right into here, because if this was a correction for another move down, then we should start to see impulsive down here pretty quick. We have what looks like right now is we got impulsive down, impulsive up. So if this starts to look more choppy, more sideways, it would look more bullish for bonds in the near term. Now, it could be we get a move up, and this is just this was just wave A, wave B, wave C, and then bonds continue to drop. That could still happen. But the way it's acting right now, it's acting like this is looking more sideways, more choppy, especially with today's move. Now, look at today's move. We opened higher. We could be closing lower than where we opened. But this is not a big run up ahead of it. The run up happened right here. We've had this little pullback right here. So this is looking a little bit sluggish right into here. So this is looking like this is looking more like this is wave A, wave B. And again, it could be sideways for a few more days, and then you get wave C up. And then we'd have to see what happens there. Does it keep going up? And where it looks like a full-blown trend reversal, where this is wave 1, wave 2, and wave 3, wave 4, wave 5, so to speak, or is it just a correction for another move down? We'll keep an eye on that. Now, bonds have dropped very dramatically over a long period of time, so we're probably getting closer to a bottom in bonds, but not that we're going to try to pick the bottom, but we are in an area where we could start to see it start acting more like an uptrend, but we're in the early stages of that. We'll see how this kind of plays out right here. The trend is still down. We really haven't broken the trend line here. If you were to connect all the highs right down through here, we haven't broken that yet. So, technically we're still in a downtrend, but we're starting to see a little bit of behavior right here that could indicate that bonds might rally a little bit in the near term. And then we'll reevaluate that. If it looks like a bearish ABC pattern or not, we'll reevaluate that a little bit later on. Gold, kind of all over the place. One thing to kind of keep an eye on if you're bullish on gold. Well, first of all, it's been holding these lows pretty good. It held right there, right here. So far, right here, it's up. Gold's up a little bit today. Keep an eye on this little declining trend line right here. If it can break above that, that would be more bullish for gold. If it breaks this support level, now that you've been hovering around here for a few weeks, if it breaks below that, that's going to be very bearish. So that's what you'd want to be looking for on that chart, near term. And by the way, there is chatter out there, more so the silver market, that silver is looking to be a little bit looking a little bit more bullish. Again, I'm not a commodity expert, and I don't pretend to be. In fact, I usually just avoid commodity trades altogether a lot of times. But that's something just to be aware of, is that maybe gold could be something that takes off and starts outperforming. Again, you don't want to base a trade off of especially chatter, because who knows, maybe it's people chattering because they're shorting gold and they're trying to trick you to come in, and then they're gonna stop you out, and you're gonna sell, and it's going to create selling pressure for another move down. But just keep an eye on those trend lines and see if we break above that. If this holds and we break above that, then maybe there are some gold trades you could consider. Let's take a look at silver real quick. SLV is the ETF for silver. Yeah, you see how it has more of a basing. It's been moving kind of a little bit more sideways right here. You could even call this a little bit of an inverse head and shoulders pattern. Probably needs to clear this area up here to have a little bit more confidence that it could be reversing trend, but that's something to kind of keep an eye on. Oil still looks like it's in an uptrend, or it's kind of reversing back into an uptrend. We talked about how we had this decline through here, and This kind of seemed to have broke that impulsive. This looked like a little bit of an ABC. Now we are moving a little bit sideways through here, sluggish a little bit. Could it be that this is wave A, wave B, and you get a wave C and then a move up? Sometimes when you're reversing from a kind of a correction or a downward move into an upward move, it can be a little bit slow and sluggish. Even on the way down here, you had this big sideways move here before it went lower. I just think, though, this lines up with the chart looking more bullish and the time of year. Now, what happens if Ukraine and Russia come to a truce? Could that cause oil to plummet? It could. If all the Russia oil suddenly comes online, obviously that'd be bearish for oil, but I don't see anything that's pointing towards a ceasefire or any resolution in the near term there for that. So I'm assuming that oil has potential to move higher. Now, another thing that you can consider in this is the movement of the dollar. Now, we talked about how this could be, maybe this is a bullish ABC pattern right here, and the dollar could start to move back up. It has moved up a little bit off of these lows over the last few days. Today, it opened a little lower right here, but it's managed to kind of rally back up. We'll kind of keep an eye on this because it's in an area right here where, yeah, you could call that a bullish ABC pattern, but it could be, if this doesn't hold and you drop lower, you're getting lower highs, lower lows. You're breaking a pretty strong support level that's right into here, and you got to start looking at the possibility that maybe you're in a trend reversal, that maybe the dollar is trending down. Now, that would be more bullish for commodities. The commodities and the dollar tend to move in the opposite direction. So what would be the key areas I'd look for? Obviously, this low is key. If you break below that low, it's a lower low, and then I'll put in a lower high right there, which would be bearish. If it can continue to move higher, the closer it gets to these highs right here, the more likely it is that it's going to break out above them. This gets back into and that's because of the concept of the retracement. Here's the last move down right here. We're at about a 50% retracement. I'd probably say the 618 is right in here somewhere. I'm eyeballing it because I've measured retracement so long in my career that I can almost kind of see where that zone is. Not that it's always perfect, but I would assume the 618 is probably right in here. So if we get above that, now the probability shifts. It becomes less likely you're going to get that move down, more likely that you're going to be moving back up. So, if over the next couple of days you're up in this area right here, it's more likely that this is a correction of this entire move up, and that you're more likely to break out higher. Okay, so we'll keep an eye on it. I'll probably be able to have a better idea on Thursday how that looks. But remember, the reason why we go over the chart of the dollar is because it can affect commodities or how commodities perform. Doesn't mean, though, that commodities can't go up with the dollar going up, because we've seen it. Oil's gone up with the dollar going up. But it's a headwind. It's going to be that headwind. You'd want to see a weaker dollar if you're going to be moving strongly in commodities. So again, if you're getting excited about the silver chart or the gold chart, like I said, we don't have any confirmation on that at all. I'm just saying some people are turning a little bit more bullish on those commodities. Make sure if that's going to be one of your trades, then make sure you're paying attention to the dollar, because you'd want to see the dollar trending down and have confidence that it's looking like it's in a downtrend to really be more bullish on those commodity trades. The VIX, again, come down. Now you have a little bit of a bullish candle right here. It's an upside down hammer, inverted hammer, which isn't the strongest bullish reversal pattern, but you've seen that volatility has come down quite a bit, but we are getting a little bit of a reversal today. So, you'd expect to see a little bit of a potential for a rise in the VIX if the market is going to move down. But I don't see anything in the VIX chart today that would indicate that there's there's a big drop coming or anything like that. It's not spiking up. And like I said, an inverted hammer is one of the more mild bullish reversal candles. I don't, it's not one of the strongest ones that I would look to really jump into when I see it. It would need confirmation for me in many cases. But we'll look for that if we start to see the VIX move up, and especially if it spikes up or has a big move up. If you have a big down day and the VIX has a big move up, there's a lot of potential for the VIX to go up from there. It's pulled back quite a bit. In fact, you are in the oversold area right here. You're in the extreme reversal risk right here. So based on that, it should start to rise here pretty soon. Whether that's right now or within the next few days or something like that. Now, you could also see the VIX move up a little bit because of what's coming this week, the uncertainty this week. You got the Fed meeting tomorrow. You could see the VIX move up in the morning ahead of that. And it may not be signaling anything except for these professional traders are hedging a little bit, making sure that they're not caught off guard if suddenly the market sells off on the news. Because what if the Fed came out and said we're raising a full basis point, 100 basis points? That would freak the market out, and you'd see a big sell-off. Not so much because the news is itself is that negative, but the market was not expecting that. It's the market has its expectations, and that's what you hear everyone talking about. Well, the market's assuming there are going to be 75 basis points again. That's what's been kind of already programmed in. If it's more than that, for some reason, the market's going to freak out, and it's going to sell off big off of something like that. If it was less, the market would take off. It would just surge, and you'd probably see the NASDAQ surge with all those underperforming NASDAQ stocks. But again, I wouldn't expect either of those things to happen, which is why the number itself is not going to be important. It's going to be, like I said, they're going to get into that Fed speak where they're analyzing every word, how they said the word, what their facial expression was when they said the word. I mean, it's ridiculous how they overanalyze those Fed reports. But and that's why it's ridiculous to try to assume what the market's going to do off of that. That's not our job. Our job is to let the big professional traders who move the market decide whether whatever happens tomorrow is bullish or bearish, and then we'll follow along. Although we got to keep in mind, as I mentioned every time around these Fed reports, there tends to be a false move a lot of times initially. So if suddenly the market starts rallying right when the announcement is made, be careful not to go chase that. Usually you want to wait. Usually, actually, you want to wait till the next day to start making decisions off of what happens on those Fed reports. There's a lot of volatility that last 2 hours, particularly the last hour. And then, like I said, sometimes you get a rally into the end of the day on the Wednesday, and then Thursday or Friday you get a big drop, or vice versa. You get a drop initially, and then it rallies. It could be it can be very frustrating to try to assume that you know exactly the direction off of that, especially since all day today we've talked about how there's signals back and forth. We could continue to be moving up, or we could be setting up for another move down. We're in that kind of coin flip market condition right now. Chip stocks, again, they're still lagging, really underperforming. It's something to keep an eye on. And transportation stocks compared to the Dow. Remember, the Dow is all the way up here. Transports are not confirming. They should be leading the way. They're not confirming that. Now, every time, I'm telling you, there's people out there. This is based on the Dow theory. If you want to go Google Dow theory, you'll get a better explanation than what I could probably give you on it. But it's been around for over 100 years, couple 100 years or so, or whatever. It's been around a long time. I don't know, at least 100 years it's been around, and it is based on the idea that again, the transportation stocks will signal how the economy is doing when it's healthy and there's products are flowing. Airlines, shipping companies, trucking companies, railroads, when they're making money and doing very well, it's a signal that the economy is humming along and doing well. When they're struggling or when they're underperforming, it's a sign that, that especially in comparison to the Dow Industrials, it can be a sign of that the market or the economy is slowing down. And so what the transports are signaling and the chip stocks are signaling a recession or some sort of slowdown. But the industrials have taken off. So again, this is why I'm very cautious about trusting the rally in the Dow, is that it's not being confirmed by not just one thing. It's not going to be. So you got all your leadership groups again. NASDAQ 100 tends to be a leadership group. Your transports are a leadership group. Your chip stocks are a leadership group. None of them are confirming the rally in the Dow. And so that's what makes me very cautious. Okay. However, you can't get so locked into that could it be that this is a unique situation where these will start catching up? Sure. And that's why whatever the trend, the market starts trending up strongly, I'm going to trade that direction. I'm not going to fight it, but with all these little clues, it's pointing to being very cautious or suspicious of the rally and not wanting to be too exposed to it just yet. And I also get back to, because I got asked this question that, because you've heard me talk about for months and months about a panic sell-off, that these bottoms usually don't take place without a panic sell-off. Not only do they not usually take place, there's never been a major market bottom in my lifetime that hasn't had a panic sell-off in it. And we haven't had a panic sell-off on this whole drop down. Now, we've gotten close a couple times. And what do I mean by panic sell-off? I mean the VIX spiking above at least 40, usually higher than that, but at least 40. That's kind of a minimum. We haven't even gotten that. So the situation is, okay, again, we have to think in terms of probabilities. Either this is going to be the one time in my lifetime that the market bottoms without a panic sell-off. It's possible, okay, but that's what I'd have to accept, is that it's going to be the one time that does it. Not to mention that combined with the Fed the Fed has never orchestrated a soft landing. They've always over tightened and over loosened when they're in those modes. So I also have to believe this is the one time where they're going to get it right, and they're going to perfectly set us up for this soft landing. Inflation is going to come down without pulling us into a recession, and the markets and the economy is going to take off again, and everything's going to be rosy. Okay, I'm not against the fact that this could be the one time when it happens, but don't fault me for assuming first that it's not. And I'll believe if the chart keeps going up, then okay, I'll follow it. I'm not going to get locked into this belief that we have to do anything. I've seen some wild things happen in the markets that don't make any sense. Maybe because everyone this time around believes that is waiting for a panic sell-off. Maybe that's the reason why it won't happen. I've talked about that in these classes, but man, I'm so programmed to look at probability. I can't even watch sports anymore because I'm so programmed to look at probabilities. To be a fan of sports, you have to believe in the low price. You have to believe that when your team's down 42-6 in the fourth quarter that the game's over. You got to believe that the game's not over. There's a chance you can still come back and win. I can't do that anymore when I watch sports. It's like I see numbers. I know the relationship of numbers. And so my mind automatically says, "Oh, this game's over," But it's the way with trading too. I tend to focus on what are the probabilities, and it's hard for me to kind of change that. And that's actually in trading, though. That's what I want. I want to be focused on the probabilities. All right, so we'll see what happens. Bitcoin had a little bit of a rally last week, but overall it's just been kind of flatlining. You could make the argument, though, this is basing towards a rally. It's been moving sideways for a long time. I mean, if you back out and look at a 2-year chart, I mean, could this be just a basing pattern to start moving back up? Absolutely, it could be. But there's always still that chance too that we have another move down. I wouldn't personally be jumping into Bitcoin until I start to see a little bit more of a, if it can hold right here and start breaking out above these levels right here, I would probably become a little bit more bullish on, because one of the patterns I like is when you're coming on the right side of the bowl. One of my favorite patterns to trade is when it's come down like this and it starts to look like you're moving on the right side of the bowl, but it just doesn't look like that yet. All right, portfolio. I did add in the hedge. I think last week I did add the SARK on Thursday. I held it through Friday's move because of the fact that we had that big move up, but the SARK didn't drop that much off of that. And then Monday we had kind of that indecision day on the markets, and then now today we opened higher and then we've reversed down. We've opened lower here. Remember, this is going to do probably the opposite of what the market does, and that's why we use it as a hedge. This is looking more bullish with today's move, so I'm going to continue to hold it. But by holding these two, it has offset a little bit of the rally in some of those oil stocks. Again, that's why I keep coming back to the fact that I'm just trying to grind out some gains. We're trying to get to 140,000. We're just trying to see if we can kind of grow this. And we know it'll be a little bit slow. But I didn't lose too much in those hedges. And then yesterday, because yesterday we had a little bit of a bearish inside day on the indexes, and so I added the SOXS on there. But let's take a look at our positions. LNG had a nice breakout, or no, there was not LNG, it was the other one. I'll show it to you here. But LNG looks like it's starting to break out. This is natural gas. Looks like it's starting to break out, and it probably should this time of year. By the way, it hasn't, it still has some room. We're not in that extreme reversal risk range, and we've been consolidating for a long time. This could go on a pretty good run. It's not a bad new entry if you're looking for a new entry. As it's starting to break out, a breakout entry is a favorite entry of mine. I like, and you'll hear me talk about it all the time. You could wait for the breakout. You'll hear me say that all the time. Well, this is looking like it's getting ready to break out. That one looks real good. MPC had the big move. This is our oil refinery stock. It's broken out. So it broke out of this previous high. Now, when you have a big day like that, a lot of times you can pull back a little bit from it. So if you're not in this and you're looking for an entry, a lot of times on a big breakout move like that, I'll usually wait, because sometimes what will happen is you'll break out like that, and then you'll come back and retest the breakout. You'll come back to this area, it'll hold as support, then you take off again, and that could be a better entry point down here. That one's done pretty well. Tech is down a little bit, had a down day on Friday. My stop's down below here, so I'm willing to just let it, see if it can find some support and start moving up again. It could be that this is developing a little bit of an inverse head and shoulders pattern, although I thought that right into here. But what you don't want to, that's why our stop is right here. But if we drop below here, then obviously I'm probably wrong with this being a bullish reversal pattern, and I'll just stop out. Coal has been just kind of moving sideways. But again, my stop's down below here. I think this should start picking up a little bit as we're moving into the colder months. I think we could start to see that move up, start performing here. CF, again, it's just been chopping a little bit sideways here, but I like the potential inverse head and shoulders pattern. And we're starting to break above that neckline, which would tend to be more bullish. If it does hold that, it should start to take off. Now, keep in mind, it probably needs a little bit of market momentum behind it. If we do pull back over the next couple of days or so, you could see these stocks pull back a little bit with it. But that's why I've got those hedges on as well in case it does. And then the SARK and then the SOXS, I added this one in. So I'm kind of holding everything. I am looking for another entry back into what is it? The NOC. It's NOC. It's the Northrop Grumman defense stock. It's pulled back a little bit today. I'm going to see if that pulls. Again, with the market looking like it could pull back a little bit, I'll see if the market pulls back a little bit. This pulls back a little bit more. But I want to get back into this one again. I got out of it because remember last week it looked like the market could pull back. Some of these stocks were in their extreme reversal risk range, and so I took some profits on them. This one, so I got out somewhere right in here, if I remember right. Then it dropped right here, opened down here, and then surged higher, and then even went higher. But I'm looking for this to pull back a little bit for another re-entry. I told you I'd probably look to get back into that on a pullback. And I'd like to get into Lockheed Martin too. That thing's gone parabolic, but see if it can pull back a little bit, maybe come back to retest this breakout area here. A little bit of a bearish candle today, so it might be signaling that it's getting ready to pull back. All right, individual stocks, real quick. We'll just go into the muscle stock scan list. I'll go have a more in-depth class on Thursday. But the CRK, I think I brought this one up before. This is a oil stock. Again, I like kind of the corrective pattern. This whole pattern looks corrective right here. A new buy signal. I just went to the new buys on the muscle stock scans. CHK, Chesapeake, I might have gone over this one before too. Again, all of these kind of look like they're forming inverse head and shoulders pattern, and that could be a breakout, major breakout area if it breaks out above there. This KEX, Kirby Corp, 93 strength rank. This is a shipping company. But it has, kind of that little bit of that inverse head and shoulders pattern look to it. Could wait for a breakout. It's a little bit of a bearish candle today. We'll wait for a breakout maybe. And then this SWAV, Shockwave Medical, 93 strength rank. And again, it's just kind of looking like it could be moving up the right side of the bowl. You could wait for a breakout to make sure these higher lows continue to be higher lows. I like the way that's looking there. It's held up pretty well with recent selling. A couple weeks ago, it didn't drop that much off of that selling. All right, that's all I have. We'll see what happens tomorrow, and let me really quickly here go back to the SPY. Let's see if that candle is still looking bearish. Yeah, it really hasn't done much since the open. We'll see how it closes there, but it's looking like it's signaling a near-term pullback. It could just be opening lower tomorrow. Like I said, that Fed news could sway the market either direction. But you got to look at it from a standpoint of the market. So the Dow has already rallied strongly, and so what I usually look at when you got a big Fed meeting like this coming up is I think the Dow in particular is pretty much traded that whatever it's anticipating. I think it's anticipating that the Fed is going to obviously 75 basis points in this one, but what they're listening for is there any sort of a chance it's only 50 basis points in December, or is it going to be another 75 basis points? But I think any sort of bullish news is you could make the argument it's already played out. It's already been, the market's already kind of anticipated that, and so it's more likely to drop. It may not move up much further on positive news, but could drop pretty significantly on any sort of negative outlook on that decision. So we'll see. Again, not saying it has to do that, but you kind of try to look at how far the rubber band is stretched a little bit. It's not overly stretched, but we are in the extreme reversal risk on the Dow. Whenever you're in that situation, it's going to take a lot more to cause it to keep going higher than have it snap back in the opposite direction. And so, although again, you can make the argument, but if it's positive, maybe the Dow doesn't move up as much, but you see the NASDAQ catch up and have big moves up. Yeah, that's something that could happen as well, which is why I should have just opened up class said we could go either way, and then saved you a whole hour of over analysis. So anyway, have a great week. We'll see you on Thursday for the stock specific class. And again, if you have any questions during the week, make sure you send those to Jerry at TradersPro.com. Thanks everyone. Bye now.